What to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information. Is there a bigger theme any time in the past 10 or 20 years than AI, artificial intelligence? Maybe by the end of today's show, we'll have an answer to that question. But I can see Trent's already in the comments and saying g'day. Today we are talking about probably one of the things that's been on everyone's mind for the past 2 or 3 years, not just with the, launch of the initial ChatGPT, but also everything that's come since voice assistants, even earlier days of machine learning and these types of things. We're going to be joined by Billy Leung from GlobalX, and we're going to be answering questions towards the back end of the show after he talks us through his slides around AI, about the way you can pull apart the AI industry. Billy has so much experience. I don't want to butter his bread too much because he's about to join us live, but he has so much experience, not just thinking about AI, but thinking about the entire technology ecosystem, and impressively, not just a US-centric focus, just technology generally. He's been doing it for a very long time, and you may have heard him in a recent podcast on the Rask Network, and you got a kind of some exposure to that. So if you are on YouTube, you can say g'day, you can say hello, and leave us your comments or questions as we go through some of the topics that we talk about today. But as you know, one of the great things about being in finance is the use of disclaimers. So I'm going to bring one of those up in just a moment when we go through the slides over here. Okay, so we can see that we're going to be live for a little while. G'day Rex, g'day Salah. Wonderful to have you with us. We're investing in AI is the topic for today. And I just want to quickly just flash this on the screen for you to see this disclaimer that I've put up here quickly in Canva. But it's just to remind you that we can only give general financial information only. We cannot give one-on-one personalized advice. So if you do have questions or these types of things, we can only answer questions as they are general, and if they are in pretty much related to investing. So if you talk about companies or themes at large, that's a much better way to have your question featured on today's show. If you do want personalized advice, please speak to a financial planner. You can find a financial planner on the moneysmart.gov.au website. And finally, if we do talk about ETFs or exchange traded funds or even managed funds and super funds, they all have something called a PDS or product disclosure statement. That is a legal document, and it's very important to read before you invest in any of those things that they may attach to. So, g'day everyone. G'day Isha. G'day Kung. Welcome to, I think that's how you pronounce it. Apologies if that's not correct, but welcome to today's show. I'm going to invite Billy onto the stage in just a moment, but I would love it if you, as he goes through his slides, prep those questions in the chat about technology, about companies, about ETFs generally speaking. Let us know what they are, because I think that's going to make for a really, really high value conversation today. So with that, I'll bring Billy into the conversation. Billy, how you going, mate?
Hi, I'm good. How are you, Owen?
Good, mate. Very good. It's always a pleasure to chat investing, but particularly when we are, I would say, and I don't think this is me with a bit of hyperbole. I think that when we're talking about AI and the companies that are within this ecosystem, I think we're talking about a theme that is just almost unbelievable to most people. Like, we've been through some themes over the past few years, but this one in particular has me really excited. So I'm delighted that you could join us, mate, and share some of your wisdom.
Definitely. I was very much looking forward to this as well.
We have some slides that you've kindly put together for us.
Sure.
And would you like me to bring them up now?
Yes, please.
Yeah, sure. So once everyone can see these, please let us know, and we'll continue from there. And it looks like we can all see this, so I'm going to make this a little bit bigger for everyone, and there we go. So Billy, as we go through, we'll invite everyone to give us their questions in the chat, But mate, where do you want to start? How do you want to start?
Oh, maybe just a quick introduction. Thanks for introducing me, but maybe just very quickly, my name's Billy. I'm the investment strategist at Global X Australia. Prior to this, I've had about close to 15 years of experience in a more fundamental equity analyst environment, both in Australia, also in Asia as well, and very sharp focused on the technology sector, like Owen has been mentioning. So I guess what I really wanted to share with everyone today is not just the investment case of artificial intelligence, but I think one of the key takeaways I want everyone to come out of this with is more the understanding or the appreciation of the breadth and the depth of artificial intelligence in our lives, and also as an investment opportunity. And that will be a great thing for me if everyone comes home with that.
Yeah, absolutely, mate. And I think what we're going to find, I've had a very quick look through your slides, and I found that I think we're going to pull it apart in multiple different ways. So we do have a disclaimer, which I'll pop up on the show here, and so people can see this. And there's a wonderful thing there, which we would encourage you to pause and read and make sure you understand before you continue through the slides and through the show. But we'll take that as read as of about now, mate.
Sure. Yeah, and I'm sure a lot of people already know about Global X, but just maybe a really quick background in terms of what Global X is, or actually in Australia. But we are a leading ETF provider in Australia, also around the world. Our headquarters is in New York. The key goal for us is to empower investors and to look at unexplored and intelligent sort of solutions. We have very strong in-house research team, myself over here with a few colleagues, but also we work very strongly with the other parts of the offices as well, such as the US. And we do have a strong lineup of ETFs and products which are looking at disruptive technology, equity income, commodities, digital assets. I think the whole Global X goal is to look at ETFs which are truly beyond ordinary. And in that slide that Owen has just shifted to, we're looking at Australia, where we manage $7 billion or close to $7 billion in AUM. And right now we have about 36 products across our ranges. And one of the latest ones, as you would already know, is the GXAI, which is a focus on the artificial intelligence sector, and probably what we could be talking about going forward as well.
Yeah, we got a lot of questions when we had Mark on the show. He was recently talking about income, and he was talking about all things in this category. But when he was on the show, we did get some questions about some of the new products that you've got as well. So particularly down the left-hand side here is where we're kind of going to be operating today. But yeah, it's an exciting topic, and I think now GlobalX is pretty well established with our community. I think having worked with you and the team for quite a while now, it's good to see so much brand recognition in the marketplace.
Agreed.
All right, mate, here we go.
Yeah, so I mean, looking at technology for so long, I think one of the best places to always start is how did we get here? How did artificial intelligence get here? We know the revolution is already here. But how do we get to a point where it's become such a household topic? We non-investors and investors are talking about artificial intelligence. Even my kids at home are talking about artificial intelligence all the time. And I think a good way to look at it is this little snapshot chart that I put on this slide that shows the past 20 years or the past 2 decades of how artificial intelligence has been applied to human activities and how they've improved. So, the little dotted lines are the different applications, and and that sort of line that's going around horizontally is where they surpass that human level. So, maybe a question for Owen. I mean, looking at this chart, what do you find interesting, or what do you think that really glows up in that chart?
I found that this orange line is plotting speech recognition, all right?
Yes.
And I find this really interesting because this looks like it started around about 2000, like where if you've got human performance here as measured, it took like 17 years to surpass human performance, right?
Correct.
But the thing that I find interesting is further to the right, all of these things have taken 1 or 2 years, or not even, it looks like in some cases, like things like code generation, math, like this is really interesting.
Exactly. I mean, it's an excellent observation. That's exactly what I want to talk about.
Okay,
There's actually two things. One is what Owen was saying, that in terms of the pace the pace of improvement or the pace of innovation in artificial intelligence, it's much faster. It's taking about 2 to 3 years to achieve human standards from AI as compared to about a decade ago. And not only that, but what you're also looking at the past decade is we're actually seeing more and more human activities being applied by artificial intelligence. So, we've seen about 3 or 4 in the past 10 years as well. And that sort of goes back to explaining why is artificial intelligence here and here to stay, and why is it becoming such a hot topic. And there's actually a few things that are happening in the market which I see as a driver of all this. The first one is the technological advancements. So if you look at the computing power in the past 10 years, it's actually gone up about 10 times in terms of transaction rates. But at the same time, this computing chips have gone down in terms of cost by 16 times. So computing is now more powerful and affordable. Number two is the companies that are actually innovating or driving this technology are actually much more financially solid. Okay, so for example, I think we spoke about this before, Owen, is if you look about 20 years ago, just after the dot-com bubble, only half of the NASDAQ 100 companies are actually profitable. But if you fast forward to the end of last year, over 80% or close to 90% of the NASDAQ companies are financially in net cash position. They are profitable, and they're generating net free cash flow. So these are really important factors because it means that their research and development is much more sustainable and much more consistent as well. And the final thing that's really happening recently in terms of what's happening with artificial intelligence is the acceptance of all these different industries. We're not getting any conflict or frictions. If you look at healthcare, financials, even supply chain, they're all very adaptive of artificial intelligence. So the reason why we're seeing much faster movement in the past 10 years is because we're seeing much more financially solid companies, much stronger technology, and the acceptance of all these different industries.
Interesting. So it's kind of like the things under the surface even.
Yeah, exactly. It's the things that, like, when people say, is this a fad? Is this something that's just a short-term trend? And if you look at all these favorable market factors, this is really supportive of what's really going to happen in the future.
Yeah, cool. Okay. Next one.
Yeah, sure. Maybe next slide. So, we see artificial intelligence as, a trend now where we're confident that this is a trend. We know it's going to be here to stay. But at the same time, do we know that this is an investment opportunity? And, are we sure that this is sort of a paradigm shift? And one of the key things that I've seen in the past in terms of looking at how technology innovation shifts is there's always a convergence of three things or three sort of sectors. And in terms of the technical aspect, they call it the three convergence of three layers. So the first layer or the first sector which I talk about is called the compute. We need this one to actually succeed, to actually develop. And the compute is what I call simply the hardware companies. These are the companies that are developing or manufacturing the hardware required to bring this technology into actuality in the first place. And then we have the second layer, which are the infrastructure companies, or what I call the enablers, the enabling companies. These are the companies which use the hardware to develop a platform so that we can actually improve this technology, okay, and essentially lower the barriers of entry. And then finally, we get to more the exciting stage. Sorry, just the previous slide, Owen, which is the interface. So this level is where there's companies which I call the adopters. And they're the ones that are actually leveraging what the infrastructure and also what the hardwares are doing. And they're using it to actually create value and to actually make new services and make new products. And we've seen this before, Owen. If you look at the PC era, it was Intel that introduced the microchips that was powerful enough to create PCs, which HP did, and they were the enablers. And it was only that we had the computing power and the platform that Microsoft was able to build Windows and productivity tools. So it was essential to have these three in place. And the internet was also a very good example as well. We had Intel producing very fast data power chips, and then we had to have Oracle and Cisco with that data infrastructure and networking to allow that transfer of data, creating internet, which essentially created Google and Amazon. And we're seeing the same thing right now with AI. We have NVIDIA creating very powerful chips to allow this development. We have the cloud platforms, AWS, Amazon, Microsoft Azure, Google Cloud platform to actually have that development and training for artificial intelligence. And now we're at that interface or adoption stage where we're seeing companies leveraging all this and trying to create value. And those charts at the bottom is where we see that there's actual value creation. In the PC era, if you look at the share price, this is the cumulative share price or share value creation by Intel and HP and Microsoft. It was sustainable for 20 years and it was actually going up. And the same with internet, with Cisco, Oracle, and Google. Again, about 10 to 20 years of value creation. And obviously it's still going on. And we are going to see that in AI.
Interesting. So it's kind of like you can see when they have that shift, how things actually, like they're creating value and how much of that is captured by investors, basically.
Exactly. I mean, this is one key thing where that people are saying, where should I invest? And if you look at these, looking at the leaders, or if you actually identify this compute interface and infrastructure layer, this is how you identify the best exposure to a certain trend.
Yeah, right. Okay, interesting. I love how you pulled it apart like that.
Yes, sure. So maybe we'll move on to next slide.
Yeah, sure.
I think so. And this is where we've gone deeper into each of those layers. So we talked about the hardware, infrastructure, and also the enablers as well. So just looking at the hardware, like I said, I want everyone to understand the breadth and the depth of where we're going. And everyone's heard about the NVIDIA chips, and the key reason why we're seeing all these chip hardware manufacturers coming up with new chips is because the fuel for artificial intelligence is data. We need data to drive all the artificial intelligence development. And one thing I always try to explain this is through one of the key aspects of development, artificial AI development, is the machine learning section. And it's important to actually dissect this into two parts. In machine learning, there's two key parts. The first part being the AI training. This is where we actually teach the machine something new, a new concept, or how to identify something. For example, how to identify an apple. And in this area, we need fast processing power or more powerful computing chips to actually allow them to move very fast, to think very fast, and to analyze very fast, which is why NVIDIA's GPU chips are perfect for this. They're very fast, they're very good at doing the same thing over and over again. But what the market may be misunderstanding, or what's gone under the radar, is that there's actually a second part to machine learning, which is the inference part. After we've taught the machines how to identify something, we need to put it to the test. So the inference part is where we bombard the machine with different data, a lot of data, and to test them to see if they identify different kinds of apples, different varieties of apples. And in this part, we need a lot of memory chips, which is why we're seeing companies like Marvell in the US really benefiting from this, because they're a big player in the memory chip market. And we're also seeing Korean names such as SK Hynix and Samsung benefiting from this as well. And it's actually going under the radar because everyone talks about NVIDIA, but no one talks about the second part of AI, which is the memory chip section. And I hope that sort of appreciates that depth of how far we go.
I think, Billy, when we spoke maybe a couple of weeks ago now, we spoke about, I can't remember, there was some statistic about how much something like fresh water or something it takes to train one of these things. It was just incredible. If you can't remember, I'll refer everyone back to the recent podcast with Billy. I just thought I was blown away. And also the number of different, like we all just think it's all just NVIDIA, like NVIDIA is the only thing, right? But there's so many other companies horizontally that are working in the space.
Definitely. I recall we were also talking about how maybe next time we should be talking about semiconductors.
Yeah.
Because this is a huge support of chips as well. And I think we were discussing how even in the semiconductor space, there's 15 sub-segments, each with their own strengths and weaknesses and huge markets as well.
Yeah, right. I like that. That's great.
Yeah. So I think that sort of shows the hardware part where there's still a lot of depth. And maybe we'll move on to the next layer, the infrastructure layer. Thanks.
So next slide.
Yes, please. So this is the infrastructure where we discussed how cloud computing is really helping. So like I said, data is the fuel to artificial intelligence. And now that we can sort of train the data, how do we actually maintain this data? And this is the infrastructure side. So a lot of people, when they talk to me, they say, hey, the cloud infrastructure for AI is very simple. It's just about having all these servers, all these racks, and just keeping and storing the data. But it's actually much more than that. If you look at AI, like I said, there's training, there's inference. It actually has a lot of variety of services provided in it. So if we look at Amazon, Google, and Microsoft, they're actually providing data analytics, data management, for all these cloud companies as well to actually train their data. And this is why if you look at data management alone, if you look at the right-hand side, that bar chart, we're seeing data management alone, that growth is going to be at 18% compound annual growth for the next few years. I mean, just on data management. And this is because there's so much drive for services in this infrastructure layer. And we haven't even talked about additional services. So for example, IBM has created a third-party tool for people that wanted to analyze their own data. So they don't need to go to Google, Amazon, or Microsoft. They could just have their own data, use the third-party tool to do their own analysis and training of their data as well. So there's actually a lot of, again, breadth and depth in the infrastructure alone. And that's why we're still seeing a lot of growth with these companies as well.
Yeah, I think we all interface with it quite differently, right? And we think we just see it's like when we drive a car, we just see the car badge. We don't see all the components that go into the car.
Yes,
And
yes.
and there's so much more. And as we've all kind of realized, unless you own maybe Tesla shares, basically all the other car companies have struggled quite a way over the last few years. But there have been wonderful companies that work within that have created significant value for their shareholders, and being able to slice it up like this is really interesting.
Exactly. I think we also spoke about this. Well, it was small. There was a small company before called Supermicro. It was about a $5 to $7 billion market cap company, which is now about 50 billion. And the reason is because they design the servers and racks that goes into the data centers for Amazon, Google, and Microsoft. And the reason for that is because there's a cloud infrastructure that has been around for 30, 50 years, but with the advancement of AI, they need to rearrange the service in terms of physically. I mean, even moving it and designing it is a huge feat on itself, which is why it's creating new services for even companies like that.
Interesting. Yeah, fascinating. You wouldn't even think, you'd think they just all sit in the same kind of like warehouse or facility, and it doesn't really matter, right?
Exactly. I mean, when I was speaking to some industry specialists as well, and they said that even moving it by 3 centimeters or 5 centimeters could improve the speed and reduce latency, and that's just incredible.
Wow. Wow. Yeah. 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 And for those of you that don't know, Billy spent some time in a high frequency trading company, so he knows all about connections and how fast things need to be. So it's right on cue, mate. So
Thank
nice.
you. So maybe we'll go on to the next slide, Owen, where we touch on I guess, the final layer that we keep talking about, which is the interface or the adopters. And this is where, like we mentioned, shows that historically in each of these developments or innovation technology and paradigm shifts, it creates the most value. And the reason is simple. I mean, Owen, I hate to put you on the test, but why do you think the adopters create the most value in a technology shift?
Well, I've been fortunate, Billy, to be surrounded by some great investors in my time, and also obviously studied technology as my undergrad. But what I've kind of, then you can correct me if I am wrong here. What your perspective is on this? And I think it's because a lot of the hardware tends to be pretty ferocious in terms of the competition, the capex required to invest in that, whereas the software providers who kind of enable and run over the top, because they're selling software, their economics seem to be really, really impressive in terms of like incrementally, their profit margins are very good.
Exactly, and I mean, you pretty much said what I was about to say. But
Okay, right.
it's the economics, it's the economies of scale, it's a scalability, and the perfect example is Microsoft. Every time there's a new PC that uses the Microsoft suite, that is an incremental revenue to them, but at the same time a limited cost to them, and this is hugely scalable. And it's the same with internet as well. Why internet created so much value was because you had one service. I mean, I'm sure there's a lot of hard work that goes into the algorithm of Google, but then as soon as there's more users, 1 million, 1 billion, 2 billion users, that is highly scalable. And that's where the value is created with a lot of these technology disruptions. And we've seen this already happening in the AI. If you look at this chart right now, it shows the operating profits cumulative for different industries. So the gray one is the software companies, or what I call the adopters, like Google, Meta, Amazon. And then the orange one is the hardware companies.
Right.
So these are the ones, like you mentioned, Owen, like high capex, it's big competition, and you're seeing that they are still creating value, but not as much as the software players. And that's purely, like we discussed, from that operating leverage. The margins have increased substantially for these adopting companies. And I think the key is that, when people see this chart, they go to me, Billy, oh, it's already happened. What does it mean? And I think, you have to understand that right now, when you look at Meta and Google and Amazon, yes, they have improved their margins. They are creating value, but they're only doing so with their existing products. Okay,
Yeah.
so they're applying it to search, they're applying it to advertising, making it more targeted, but we are yet to see this new service or product created from AI, just like we saw with Microsoft, just like we saw with Google, and that's what I'm excited with. And a lot of people go, okay, fine, Billy, you think there's a new product, what could it be? And I think it's already coming out. If you realize in the past month or so, there's a lot of news about hardware, such as Google Vision Pro, and also Apple Vision Pro, and also Google's interface as well, and Meta's working on more hardware as well. And the reason is because I see personal assistance as one of the monetization or commercialization of future AI. I mean, like we talked about, imagine walking outside the house, you have something on your face, and then the AI sees what you're looking at, whether it be food, picking your clothes. The personal assistance market is huge, and it's intuitive as well. And I think that's where we're going to see this gray bar and even the yellow line actually re-accelerating. And that's what we've seen in the past before.
Interesting.
Please.
So Billy, so you're saying like you think that like say like Apple's Siri, which is like at the moment kind of like helpful. Like yesterday, I said, hey, I'm not going to say the words, but I said hello to my Apple device, and I said, can you set a reminder for tomorrow? And it set it automatically, or these types of things. Are you saying like that kind of a market could be commercialized in a big way?
Definitely. I think definitely. I think if you look at how we use Siri, how we use Google right now, it's still very passive, right? There's only a certain number of actions they can actually do. My kids run up and they go, can you play a certain song X, right? But if you ask them, more complex questions like, oh, where should I go? What's a good dinner place? The only thing they can do is show up a list of results from the search. But there's no expansion in terms of trying to make a very solid decision for you. And I think that's where the difference is from going from passive to actually reactive. And that's where the shift from like technology really happens and begins. Because I look at things right now, it's very well, if you look at latest Google results and Amazon results, margins are going, the big winner or the big surprise. But the next step is actually where the margins are improving, but how do you increase that sales as well?
Yeah. So it's interesting. Do you think, and sorry to keep following up here, but do you think that would most likely take the shape of like a subscription, like a assistant as a service type thing? You know what I mean?
Yeah, I mean, I don't want to go as far as to trying to identify what the model is, but yes, that is what I'm trying to sort of imply, that there is that monetization ability with an assistant service, and it doesn't have to be expensive. It doesn't have to be expensive as well. I mean, no one could have guessed that we would be paying for viewerships of content online, and everyone's doing it. I mean, if you look at the US, on average, do you know that how many video subscriptions on average a US person has?
No idea.
They have five. They have five on average, 5 subscriptions. So it could be probably the 5 main ones, Hulu, Apple, Netflix, and whatnot. So it's incredible. So these are becoming a very essential part of our lives and a common thing as well. So I do see this as a very something that could happen, Owen.
Yeah. Well, I guess in the business space, one of the things I wanted to talk about today was in the business space, like the GPT like backed models are just like crazy in terms of what you can do, like Microsoft Copilot, Google Gemini, and those types of things are just already assisting us. It's not really that conversational, although I think the new GPT-4o from OpenAI is kind of getting quickly towards that, and that's just fascinating stuff. So quick question from me, and I'll throw it over to. We've probably got time, guys, for a couple of questions for Billy from everyone. So if you do put your questions in the chat now over on YouTube, that'll be great. And I'm just going to bring up and share a different screen with everyone. So 1 second. And this was more a question because one of the questions that I asked you on the podcast recently was obviously GlobalX is the new artificial intelligence ETF GXAI, and we did have LD. You said you're an OG GXAI investor. Got some on April 15th. Well done to you. One of the questions that I asked you on the show, and we can see the different holdings. This is just for everyone's benefit that's watching. One of the best things you can do if you're interested in a theme is go to the ETF provider's website and look at the holdings, because you can see kind of like what the index inclusions are. And then you can go and explore these companies and you can go and learn about them and so on and so forth. But the question I wanted to ask you was something that I asked you a little while ago, which is if we go to the country breakdown, hypothetically, so say like this ETF has nearly 70% of the securities listed on the US stock exchanges. But say, for example, if you go to any global ETF, there's like a heavy tilt towards the United States. Do you think it's worth investors looking outside of just the US for these types of companies?
Yeah, I think, look, there is always an opportunity, but I think there's two things to note. I mean, if you look at the US market, why we always have a tilt towards US market, no matter which kind of ETF provider, is because we have to accept the fact that US is the largest capital markets in the world.
Yep.
And we also have to accept the fact that US is where there's innovation. There's innovation. I mean, there's a lot of different reasons why it is in terms of politics and all that, but it is a ground for innovation, and we have to accept that truth. So that's why I think in general, when you are looking at technology, or in my history, there's always a tilt towards US companies. That's one thing. But I think also more importantly, we have to know is that even though when you look at that breakdown, it seems like it's very tilted towards US equities, and you are right. But you have to understand that a lot of these US companies are actually global companies. So I think maybe if you're a fair representation of what you're really buying into would not be looking at where the companies are listed, but really taking it out and then going, where are the revenue coming from, or where are the profits coming from? And I will assure you, if we actually broke it down by revenue or profits, that chart would not be tilted towards the US. It'll be much more global. I mean, if you look at Meta, their earnings are shifting away from the US as well. So I don't know if that answers your question.
No, it does.
That's how I look at it. Yes.
It's kind of like the next layer down, isn't it? You're saying don't just look at the hot, like say, for example, Tencent or even Amazon, Netflix. Like I have a Netflix subscription here in Australia, but I'm not in the US. But that would show up as US revenue and a US company in this ETF because that's where it's listed. But really, it's a global business.
Exactly. So you're getting an exposure to global, whether about, if a global economics, you're exposed to, like you said, the Netflix will be exposed to Australian consumers as well. So I think it's much fairer if we take it out. But obviously, there's a lot of reasons why, it's represented like so. But I think it's always important when we're analyzing, especially investments, is like, really are you buying? I mean, even we can go down to like deeper levels where let's not do profit or income or revenue. Let's look at just the operating line or the specific revenue line. There's so much, little things we can look at, and I think that's what makes our investing interesting.
Yeah. It's there was one good question from Wallace, who asked, does it include AI infrastructure, the GX AI ETF?
Yeah, so no per se. So what we are really looking for is more the adopters stage. So in terms of the GXAI, we're looking for companies that are actually providing a service that are actually exposed to artificial intelligence, and this makes up the largest part of our of the fund. So in terms of maybe infrastructures like data centers, that would not be a huge component. But like I said, if you're looking at the exposure of maybe the enablers, you also have Qualcomm and Broadcom, which are in that layer where it's networking infrastructure as well,
Right.
and has that data center exposure.
Yeah, that makes a lot of sense. Megan wrote in and said, way back in 2002, I studied a unit at Curtin University with speech recognition as a focus point. And that actually goes back to one of your charts now, come to think of it, it was around that time. And we got told it would be superseded so fast. This talk today about the 3 layers would have really helped. Well, yeah, that's funny, isn't it? Like, because that's exactly when that chart started, basically. So fast forward to now, how that's changed is incredible.
Yeah, and maybe this is a question that we can sort of ask now. It's like, for you, what I mean, if you look at that chart again in terms of that super going through surpassing human intelligence, what a question that I've been getting a lot is they're saying, Billy, how come that chart plateaus after human intelligence? Why doesn't it just go straight up?
Yeah.
And that's interesting because when I hear about it, it's like that answers the question as to why AI will always be under our control, and it's because it never surpasses a lot of human intelligence. Is because the testing of the AI is the inputs of us. So when we're testing the AI in terms of surpassing our intelligence, there's only so much we can do. So that's why whenever it surpasses human intelligence, it plateaus because of the insufficient data that we can provide to actually test it. And that goes back to a lot of people going, oh, that's why AI can never really be, taking over the world, is because they're only as good as their inputs, and we are the inputs.
So you're saying like we're in this chart,
Sure.
which I'll bring up just to clarify for people. So you're saying like in this case, we've got the orange line, which is mapping speech over time. It gets to a point and it kind of plateaus, but then so does this other line here.
Yes.
It kind of gets
Yes.
to a point where it goes above human intelligence, but then it kind of plateaus over time.
Exactly, because for testing them only goes as good as how well we test them. We can't test them for something we don't know. So they're only as good as our inputs. And I think that's the crux of artificial intelligence. They are based on inputs. Artificial intelligence is just a simulation of our behavior by machines, and that's it.
Oh, wow, that's fascinating. Well, Billy, this has been illuminating for me as someone who loves technology and is also a lover of investing. So you obviously, like we said a couple of weeks ago when we last spoke, you kind of like have that deep bottom up approach in terms of how you think about the companies and the layers and the components that make up an industry. And it's been really, really helpful to hear you speak today. So on behalf of everyone here today, I really appreciate you taking the time to join us on the show.
Yeah, no, thanks for having me. I really enjoyed it as well.
Yeah, wonderful, mate. Well, we'll say goodbye for now and enjoy what's left of your day. And we'll see you next time.
Thank you.
So that was Billy from GlobalX. You can find out more on the GlobalX website. I will just show you some things just quickly before I am here to answer your questions as well, of course. So you can head to the GlobalX website, and some of the questions that we had, which were great, is effectively like how are the ETFs constructed? If you go to any of the ETF providers' website, go beyond the holdings, scroll right down the bottom, you can see the product flyers and fact sheets. So if we click on product flyer really quickly, in here, you will effectively see why an ETF has come into existence. So like, what is it that the ETF providers research is telling them of why this ETF should come out and why it matters to investors? And this is a great starting point. And one of the things you can do is you can look through things like this and you can see, well, 56% of businesses are now utilizing artificial intelligence to improve their business operations. But then you see there's like a footnote, right? And if you want to dive really deep, you can go straight down into the data. So when I interviewed Billy a few weeks ago for the podcast, I went into this document as well as the PDFs, but I went in here and I looked at these and then I went to the footnotes and then I found out where all of these things were and also went in and dove into those reports and industry reports. So you can get a richer, deeper understanding of what the theme is. Now, for those of you that may be tuning in for the first time to a webinar such as this one, you can ask me any questions. It doesn't have to be related to AI. You can talk to me basically about anything, whether it's investing generally or what have you. Wallace, you say, will GXAI be included in any of the Rask Invest portfolios? Well, Wallace, at the moment, you will know. I can answer this in a few different ways. That's a good question, mate. So at the moment, you will know that we're building core portfolios for our community. So we have portfolios that we manage on behalf of our investors. And at the moment, there is only 3 options, right? And they're 3 core strategies. And one of the things every investor should always ask when it comes to an ETF, or even, to be honest, not just an ETF, even individual shares, listed investment companies, even investment property, we are very, very passionate about this. And I think you know this, is it a core or is it a satellite exposure? A core position being something that is typically really low cost, typically well diversified, somewhat predictable in the sense of that we don't, past performance is not indicative of future performance, but we kind of know based on history roughly kind of what's the range of expectations from this. So that's the core. And then the satellite is what I would call more thematic ETFs, what I would call, where I would put individual stocks if I was taking more of a higher risk type of bet, maybe even more exotic type investments that aren't just stocks or whatever. So I would probably put this in the satellite component of a portfolio, in which case, they're not in the 3 core portfolios yet. It's early days for both the ETF and for our service, but I hope that explains that. But I think what we're working on is allowing people to have their own satellites in the future. where they can then tinker and put their own satellites against the core. So that's just an FYI. But I think if anyone's listening to this and you're actively building your own satellites, the things that you should consider are, how does my core overlap with my satellite? So if I bring this up again, I'll get to your question in a moment, Lee. If we bring this up again and we go to the holdings, right? So basically what we're getting at is, how does this ETF, based on what's inside it, blend with what's already in the core? So a lot of investors might be inclined to put something like, say, I don't know, like N100 from GlobalX, which is an ETF that tracks the companies listed on the NASDAQ stock exchange, excluding financials and all of that. So the companies like Apple and whatever would be in there. But Apple is also in like core ETFs, like VGS from Vanguard or IVV from iShares, like core low-cost ETFs. And the problem that you have there is that it's not a problem. You just got to be aware of it. You've just got to be aware that if you piece those two things together, I'll turn off the sharing screen one sec. If you piece those two things together, you're going to have some overlap somewhere in the middle. And trying to get an estimate of what that looks like is sometimes quite difficult. So you just want to be aware of how they go together. Now, this ETF in particular, because this ETF in here, it does have NVIDIA, which is obviously going to be in some of the other ETFs. It's got Meta, it's got Amazon, it's got Alphabet. These are pretty big companies, right? So they will be represented in your core portfolio probably some way, but I'm guessing not just you, but everyone that's listening. So it's just about managing that exposure. And once you identify that, hey, I do want this exposure. So let's say, for example, I think, like, if this was my opinion, it's not my opinion right now, I'm just using it as an example. But let's say, for example, I think, based on what Billy said, I believe that Meta, Microsoft, Apple, Amazon, I believe these businesses will keep dominating even as AI takes off, because these businesses have the eyeballs, they have the users, and they have the assistants. Billy mentioned assistants, like what is coming in the future. Now, if you believe that, then you have to think to yourself as an individual investor, that's what I want. I want exposure to that thing. Okay, how do I go and get that? So you might look at, say, a list of ETFs, if we go back to all of the products here, and you might say, well, I believe Apple and Google and all these companies are going to be in that ballpark. So what you might think then is, well, which one is the best exposure to that? This is a principle that we have at Rask, and we call it the best expression principle. So you have a view of something. What's the best way to express that view? And I can see Mick's put some of his comments already in the chat, which is great. But like, for example, if you just wanted exposure to big tech stocks, you might want to look at something like FANG, because FANG has much more concentration of just these things. It'd be like if you mix cordial, right? You're all familiar with how you make cordial. You mix the syrup with the water and then you get the concentration, right? But imagine you have, you wanted to make raspberry and lemon, right? You had some weird fantasy about making your own lemonade that's like raspberry and lemon. Well, you might not pour equal amounts in. You might pour a lot of raspberry in and a really concentrated bit of lemon, so that you don't need to put as much of your cordial in lemon. You just have a little bit that does enough to cover the whole drink. And it's like when you build a portfolio, you may not need to necessarily have just that ETF. You may be able to have a smaller slither that is more concentrated. And in this case, you might choose something like FANG or any of the others. And by the way, totally not paid to say this, just generally using it as an example. I hope that makes sense. Lee, you said, hey, on what's your thoughts on 50% IVV, 40% VAS, and 10% VAE? Obviously, Lee, I can't give personal advice through the live shows. I know you know that. But just generally, I can talk about, we've got some people in the Rask community. Let me see if I can bring this up really quickly. This will answer your question in a different type of way. Sorry for my fun background there. But if we go here, this is the new Rask community that we've got up and running. And Kevin, I think it was Kevin's one the other day. He did something like what you're talking about, Lee, in that he said, let's have an ETF fantasy league where you can kind of build your own portfolios and then track them and then you talk about them and do all this sort of stuff. And SLT did the same thing, right? So you kind of like build these little fantasy league portfolios, and that combination of what you're suggesting there kind of came up in the community. And so this is my thing around when you do these. It's very easy with ETFs to go and get the data and be like, well, I'll just combine these 3 or these 5 or these 10 because they did well in the last 5 years. I would say just be mindful that that's probably not enough to truly understand what it is that you're investing in and why it may be the same or different in the future. For example, a question that I put to Billy before was, what about outside of the United States? And he was like, well, you got to look beneath the surface and all that sort of stuff. But we do know that companies like Alibaba, which is in the ETF GXAI, companies like Alibaba, Baidu, Tencent, these Chinese companies are doing great work in technology. And there's some European companies too, and even some Australian companies, not nearly as big, but you get the idea. But I think if we look back over the past 30 years, it would be very easy to have a very big portfolio in the US market because they perform pretty well. But we've got to unpack it. We've got to go a step deeperly, and we've got to say to ourselves, well, why did they do well? And a big reason that obviously US companies have done very well is obviously the US, like Americanism has been spread throughout the world, globalization, Western democracies, stable financial markets. We can also see like a kind of the reverse brain drain. So there's this idea called, brain drain, which is where people that are really talented in second and third world countries that go to universities, get really high marks, become doctors or scientists or whatever, they tend to they gravitate towards first world countries because they have more opportunities to do good work and to get good salaries and all that. And for the many reasons, for the last 30 to 50 years, the US was that destination. It was where people went to work in Silicon Valley. Like, you've probably got friends or family who know someone that went and worked in Silicon Valley at one of these places. And this is a roundabout way to say is just be mindful of when these portfolios, hypothetical portfolios, are put out there, that it actually goes down to nuts and bolts and people understand why they work and how they work. Because it's only when you do that level of research that you truly understand why they might persist in the future or why they might not. And I'll give you a good example is for the last 20 years, a lot of investors have had a pretty big allocation, like professional investors I'm talking about, have invested a lot of their money in emerging markets like China, these types of places, India, because it makes a lot of sense. Fast growing economy, lots of people, more money, seems to make sense. Yet if you go and look at some of those markets and sub-markets over time, they haven't done nearly as well as some of the more mature counterparts. And what we found at Rask is that one of the big reasons why those markets haven't performed as well is actually because despite all of their promise and despite all of it should happen, things like government regulation and things like unstable financial markets were kind of the big reasons why that actually didn't work out for them. So imagine that, like Billy mentioned before, that if you have the 3 different layers of AI, hardware, infrastructure, and the kind of the application layer on top, the application layer, the Googles, the OpenAIs, the Microsofts, these types of businesses collect most of the value, right? But they can only collect that value because of the layers below it. Now, let's say you have, we're not talking about AI anymore, we're talking about stock markets. And let's go to say like Asia somewhere. And over there, we have stock markets just like we do here. Like I've got some team members in the Philippines. They have a stock market too, right? But when you look at those stock markets, a lot of the time, not always, but a lot of the times, they don't have the same returns as even the Australian stock market, which seems kind of boring, like banks and resources, right? And the big reason is the things that are underneath the surface aren't nearly as conducive for stock market investors. And so there's multiple layers to that is what I mean to say. And to bring it finally back to your question is that I think most investors underappreciate the need for things like bonds or fixed income, underappreciate the need for things that aren't just stocks and property. I think there's a whole world in between those two things. and they're worth exploring. And ETFs do that for us now with credit ETFs, senior secured loan ETFs, this literally hybrid ETFs, subordinated debt ETFs, cash plus ETFs, geared ETFs, inverse ETFs. Like the list, just thematic ETF. There's so much. It's so many different ways, and I think it needs to be a bit more sophisticated. Sorry, I don't mean to affect, but I just think it does need to be a bit more sophisticated, particularly in retirement. Mick, you said, my concern with the AI cohort of ETFs is the overlap with the NASDAQ type ETFs, such as NDQ. Is that valid? It's also why I like RBTZ. Yeah, Mick, I'd say that's a fair, no, I wouldn't say it's a criticism. It's just a fair assessment, because let's be honest, all of us only have 100% of a portfolio to invest at any one time. Like we can only invest 100% of our money. And so at any one time, it's not necessarily, we can't just pile more in and expect to get a better return. It's how do we allocate that money, and whether that's stocks or whether it's different types of ETFs or managed funds or whatever, we've got to be mindful of where things are allocated and how that will blend with a portfolio. And I think all of us here today, and I think most of the people that are part of the Rask network over the next 5 to 10 years, won't be asking ourselves, well, what is an ETF? How do I use one? They'll be going, how does this blend with my existing portfolio? How do I expect the returns to behave alongside my other parts of my portfolio? And will that fit well with my risk tolerance? Those are the more intelligent questions. And you're onto one there, Mick, in that where the industry is now catching up to this idea of overlap. As individual investors, as professional investors, sorry, we have the luxury of using some tools to do this, Mick, where we can effectively see through portfolios at any one time, and then we can see what the true overlap is. And that's a really valid point that you bring up. So I would say yes is the answer to that. I'm going to see if I can bring something up for you. Okay, I'm just going to bring something up. 1 second. BHY. No, I won't use that. I'll use AYLD, something like this. Okay, so when you look at, you can use comparison tools like this. We've got the Rask comparison tool. This is a very primitive one that we've been building with Navexa. Navexa is a software that helps you track your portfolio for tax. It's a really cool piece of software, and you just plug it in. It reads all your broker statements and then helps you do your tax at tax time, but also performance reporting and stuff. And you can see when you use a tool like this, you can see the differences in, I guess, two ETFs side by side. And this is kind of where the industry is going. This is where the industry is now in terms of us being able to compare ETFs by both return and the risk. The higher this rating, the more volatility. But in the future, what you'll be able to see, and we'll be able to have access more as individual investors, is you'll be able to look through portfolios. And these tools are coming. And the reason I know this is that, like, we've been starting to collect that data at Rask, and I know a bunch of other companies that do it as well, so that everyone can now start to see side by side what is inside their ETFs and does that fit well. I wanted to finish off, maybe given that we've only got 3 minutes left, unless you have any questions for me, chuck them in the chat now. I wanted to finish off with one point, which is that us as individual investors, as we look towards the future of investing, if we look at, say, what Billy was talking about today and the incredible amount of research he brought to today's show, one of the things that I think is going to happen as a result of AI is, I think what we're going to find is that a lot of what we know about investing and how we do it is going to change. And let me give you a really interesting example of this. So Billy mentioned voice assistants. Imagine if there was a voice assistant for stock market investing. I don't think that we're actually that far away from it. In fact, I've kind of even tested models that already do that. And one of the things that I've found is that, and we've been talking about these on the podcast for years, is that if you're out there and you're investing in individual stocks or even some types of ETFs, and you think, I'm pretty good at this, I'm really good at individual stock investing, and I think the reason I'm going to do better than an index fund is because of X, Y, and Z. If one of those reasons is our ability to analyze data better than someone else, I don't think that that's a real thing anymore. I don't think any human being has the ability to analyze financial data better than an AI. And so I think that's only going to become more pronounced over the next 5 to 10 years. So if the strategy relies on you analyzing lots and lots of data, just don't put everything behind that. And what I mean by that is use that core and satellite approach. Sure, you might have your individual stocks in a separate portfolio or over here, but have the ETFs as a core just in case the individual stock thing doesn't work out. And it can still be fun. You can still scratch that itch. You can still learn, and you can still potentially outperform the stock market. But do that and quarantine it in the satellite. Be sensible and long-term focused with the rest of it. So that's all I've got time for today, guys. And I really do appreciate you joining into the live show today. We have one final live show this week, and it's on tomorrow at the same time at 12. It's going to be fun. So if you're on the Rask YouTube channel tomorrow at 12 noon, my friends and I, being Pete Wargent and Chris Bates from the Australian Property Podcast, we are going to hit back at some of the research in the property industry at the moment, and we're going to do 49 reasons why the Australian property market will keep going up. So if that gets your blood boiling, if that sounds like a bit of fun, come and throw some digital tomatoes at us. That's at midday tomorrow, being Friday, on the Rask YouTube channel. 49 reasons why property will keep going up. Obviously, there are many reasons why it could go down, but we've come up with 49 reasons why it could keep going up. So come along, check that out. It'll be a bit of fun, a bit of tongue in cheek, and you can speak to Chris and Pete. But that's all we've got time for today, guys. Thank you so much. Thank you so once again to Billy and for Global X. Lee, see you there. Bring your tomatoes, Lee. Bring your tomatoes, mate. And we'll get that sorted. Sounds depressing, says Aisha. Yeah, it does. It does sound depressing, but you know what it is? You know why we wanted to do it? We thought if we could say 49 reasons why the Australian property market will keep going up, is because we wanted to remind everyone that even though you might read something in the news about interest rates going up means property goes down, we wanted to remind everyone that there are so many reasons that stocks go up, properties go down, stocks go down, businesses come, businesses go. It's not just one thing that determines the future of an investment. And so we just wanted to remind that, and we remind you all of that. And the way we thought we'd do that is we'd just put ourselves up on the live show and just come and throw your tomatoes, and we'll have a chat. Calvin, you've said, how about the boat market? The boat market is definitely going down, Trent. If you're looking to buy a boat, I know a guy that's selling one. Calvin, you said how Tony Stark interacts with Jarvis is a classic example of where we are heading with personal assistants. I might bring something into the chat. I've never done this before. So I want to show you something, Calvin. Right? I am going to bring something up here, and this is definitely not owned by me. On my phone right here, I have a subscription to ChatGPT, the most advanced version of ChatGPT. I pay a monthly subscription. Now, it can actually talk to me. So what I might say, wait for it to connect, and we'll see what it does, right? Hey there, can you please say good afternoon and goodbye to everyone that's watching live on the Rask webinar at the moment? Let's see what it does. Here we go.
Good afternoon, everyone. Thank you for joining the Rask webinar. Goodbye and take care.
Now that's it. If you actually ask me, I think we're already here, Calvin. And I think that the reality is the voice assistant's already here. How do I know that? Because I've been asking it to run simulations and questions of investing for me on my drives home in the car. So I think we're already here. I think Jarvis is already here. It just might not be as illuminating as the Jarvis from Tony Stark's house on the side of a cliff. So thank you, guys. Thank you for today. We'll see you tomorrow at 12 midday for the final Rask live show for a little while, which is the 49 reasons why property prices will keep going up. Stay tuned on the YouTube channel, and we'll see you then. Bye for now.